The US electric vehicle market is facing a major slowdown in sales growth that has led to bankruptcies, canceled IPOs, and reduced manufacturing production across the sector as companies are quickly cutting back on their EV plans. This electric vehicle sales slowdown has caught many companies completely off guard, as most of them were counting on EV sales growth continuing to accelerate. And to complicate things even more, China, the world's largest electric vehicle market, is facing an EV slowdown of its own and is looking to export its excess capacity into Western markets, which could introduce even greater competition and chaos into the struggling EV market. Now you might be wondering how we got to this point. After all, electric vehicles have been treated as an inevitable transition. The Biden administration even touted the lofty goal of having half of all new vehicles sold being EVs by 2030, with auto manufacturers eagerly agreeing. And to accomplish this, the US government has offered significant incentives and tax credits for people to purchase electric vehicles. This created an investment boom in the whole EV supply chain, as companies raced to build EV plants, battery manufacturing facilities, and to establish mining operations for critical materials in the EV manufacturing process, like lithium and nickel. But it's become clear that despite all of the investments in manufacturing capacity and technology, the current pace of electric vehicle adoption is slowing noticeably. Year-over-year sales growth for electric vehicles in November of 2023 was 42%, compared to around 70% just the year before. In addition, the average number of days it takes for a car dealership to sell an electric vehicle has increased substantially in recent times, with it taking an average of over 60 days to sell an EV, which is significantly longer than the time required to sell a gas-powered vehicle. This is a major change from 2022, when electric vehicles generally sold even faster than gas-powered vehicles. And the demand for electric vehicles is very unevenly distributed throughout the United States, with most of the EV demand being concentrated in states like California and Washington. EV demand is also much higher in urban areas where charging infrastructure is more readily available. At the heart of the oversupply issue for many auto companies is a miscalculation of consumer demand. These companies were ramping up EV manufacturing and banking on a demand surge that simply never came. Now the market is facing a major supply glut of EVs that are forcing manufacturers into a price war. As Tesla has repeatedly cut prices on its vehicles, other manufacturers have been forced to follow suit in order to clear the oversupply that already exists. This is causing the average retail transaction price on electric vehicles to fall significantly, which is pressuring profit margins for many companies. And for many unprofitable startups that only manufacture EVs and don't have a profitable gas-powered vehicle business to fall back on, this is potentially a death sentence. The oversupply issue EVs currently face could also potentially be made even worse due to foreign Chinese auto manufacturers. As China's own EV market growth has sharply declined, Chinese EV companies now have the ability to manufacture millions more in vehicles than they are able to sell domestically in China. So these companies are now eyeing Western markets as a way to export their manufacturing overcapacity. China's government has explicitly encouraged these EV makers to expand overseas, and companies like BYD are considering opening manufacturing plants in Mexico, which could potentially allow them to circumvent US tariffs and more easily enter the US market. Tesla operates in China and has competed directly with these Chinese EV companies. And Elon Musk warned in an investor call that Chinese electric vehicles would pretty much demolish other American car makers if they are able to enter into the US market. Many of these companies offer more robust options and competitively priced electric vehicles than what US car manufacturers currently offer, which could allow them to take over the US EV market if they go unchecked. This has led the United Auto Workers Union to worry about the threat of Chinese EVs, and it has lobbied for the government to further increase tariffs on Chinese vehicles in order to prevent these companies from flooding the struggling market with even more supply and threatening domestic car manufacturers. The reasons behind the EV demand struggles in the United States are multifaceted. Many of the early adopters that were very interested in buying EVs have already done so at this point. So this has left car companies with the challenge of convincing the general population to trade in their gas-powered vehicle for an electric vehicle. And convincing the average American consumer to do this has been much more challenging. Many Americans are unwilling to make the change to an EV because it's simply not as practical as a gas-powered vehicle at the moment. The lack of charging infrastructure compared to gas stations, limited battery range, and charging times are all common concerns that buyers have. In addition, even though electric vehicles are starting to become more affordable, they are still much more expensive than gas-powered vehicles. And the reality is that the majority of consumers are not willing to pay more for a car that's currently less practical to use than a gas-powered vehicle. Automakers are coming to terms with this reality, and this has led many executives to walk back many of their targets surrounding EVs and to take a more cautious approach to the market. GM recently abandoned its EV production targets for 2024, and Mercedes-Benz delayed its electrification goals by 5 years. Interestingly, one company in particular has come out ahead in this situation. Toyota, one of the world's largest auto manufacturers, has for years argued that the electric vehicle transition would take longer than people expected. They warned that consumers would be reluctant to buy fully electric vehicles due to their higher cost, and argued that hybrid vehicles would be needed for a significant period of time as consumers warmed up to the idea of electric vehicles. This was a pretty unpopular opinion among many analysts and other car manufacturers. But Toyota's business strategy has been vindicated as the adoption of hybrid vehicles has grown faster than electric vehicles. Last year, hybrid vehicle sales rose by 65% compared to just 46% for fully electric vehicles. With the majority of consumers concerned about prices and the lack of charging infrastructure, Toyota's focus on hybrids has let them bridge the gap in the market by offering a more affordable vehicle that doesn't rely fully on charging. And right now, Toyota, Honda, and Hyundai dominate the hybrid market in the US and make up 9 out of every 10 hybrid sales. Other car companies like GM that previously dismissed hybrids and focused entirely on electric vehicles are now being forced to pivot and to reintroduce hybrids as it's becoming increasingly clear that consumers are simply not ready for fully electric vehicles just yet. Or as Toyota's chairman and former CEO Akio Toyoda put it, people are finally seeing reality. But let me know your thoughts on the slowdown in the electric vehicle market in the comments below. And be sure to subscribe to the channel for more finance and business content. Thanks.